This week, Learning Saturday, we have interesting webinar and one power-packed workshop only for you. Morning 10 a.m., we have Festival of Beginnings, your first crore journey with Kodeeswari, a women-only workshop where you can learn how to set goals, invest smartly, and take your first step towards 1 crore by Aishwarya Mahesh and myself. At 1 p.m., we also have a very interesting webinar, Make Your Superannuation Work Harder for You. This is specially for Australian NRIs by Nakul Janakiraman and Harshil Nichani. Don't miss out, register now and secure your seats now.
Hi everybody, welcome back to another video for Know Your PMS. And in today's video, we are going to be speaking about one of the most debated topics, PMS versus MF. And for this conversation, I have with me somebody who's worked across multiple teams within the organization and is also a CFA and CFP by qualification. And you would have also seen her across all of our social media handles. We have Samyukta Vibhu. Hi, Sam.
Hi, Ice.
So the first question I have for you is, because this is a most asked question by all investors and all of the clients that you deal with, how do you sort of settle this argument? Or is there a settlement to this argument?
Yeah, I think it's an interesting question, but if you start looking at how people have changed their perception over both PMS and mutual funds over the last few years, there's a nice change that you're seeing. So previously, I think this PMS was a very aspirational product where a lot of people felt that, once I get to that 50 lakh milestone, then I want to move into a PMS because there's so much more customization, or it just seemed far more exotic. But now you see a lot of investors who've participated in mutual funds who've been able to create wealth, quite satisfied with what they're doing there. And I think both products have their own space in each investor's portfolio. And as you cross bigger milestones, you will find that right balance between the two. And I think we need to break out of that mentality of one or the other, because both are fantastic ways to create wealth. It's just that the way in which you do it, and there are some features which are different between the two, which help you achieve certain things, right?
Okay, so you make a very interesting point about how they're both different, right? Which brings me to my next question. How is a PMS different from an MF just beyond the minimum ticket size?
So there are a few things that I would look at. So first, in terms of mandate, so I think when it comes to a PMS, they can take more concentrated positions in securities. You also have less of performance pressure. So I think mutual fund industry wide, there is a lot of pressure to do quarter on quarter, or even manage your liquidity really well as a fund manager, because you are responsible for funding redemptions as and when they occur. Now, when it comes to a PMS, because most accounts are segregated, there is no liquidity pressure that the fund manager has. So they can actually operate on a very different model because your asset liability mismatch is very different, right? So I think this is where fund managers can add value through the PMS route. The second sort of situation would be in terms of your fee structures, because I think industry-wide on the MF, you have like a capped range, and you also have like an exit load. Most people have an exit load for 1 year. Whereas in the PMS model, you can have a flat fee, you can have a performance fee, you can have a combination of both. So it's important for an investor to really know how much they are paying or what they're paying for rather, because I think otherwise the conversation gets diluted, right? Even when you look at mutual funds, a lot of investors keep doing this regular versus direct comparison and then saying that, if I had done it in direct, I would have saved so much. But that doesn't really make sense, because when we look at the kind of product selection that direct investors have chosen versus those who are advised, there is a quality difference. So similarly, just because optically you're paying a higher fee or you have a different fee structure than a mutual fund, doesn't necessarily mean that you're not getting value for your money. So you need to look at both things. You need to understand, of course, sometimes people don't understand the performance fee structure or why in certain years they're ending up paying more, or they prefer to have a performance fee structure because of the perceived incentivization that's there, right? So I think that is another area of difference. And of course, I think taxation is something that everyone talks about, because when a stock or a security is sold in a portfolio management service, then its tax impact is borne by the investor. But when that happens in a mutual fund, that churn doesn't really affect the investor's tax liability. It's only when they sell that you get that tax impact.
You touched very briefly upon how a fund manager adds value to either of these products, right? How do you think the process followed by a PMS fund manager versus that of a mutual fund is different? Because now that you are also on the PMS side, how would you think the process differs?
So this is a very interesting question, right? And I can't really talk about industry-wide in terms of like how portfolio management services operate. But when it comes to ithought PMS, let's say you have somebody who is doing a monthly investment, which is similar to an SIP. Now, where does that money go? When you look at what happens in a mutual fund, it just goes into the entire portfolio because all investors have the same portfolio within a mutual fund. When it comes to an investment in ithought PMS, what happens is that it's more contextual in nature, right? So at the time of the cash flow, what are the opportunities that are available? It's not a total rebalancing of the portfolio based on the money coming in. Whereas in a mutual fund, that would be pretty much standardized across all portfolios. So here, an investor actually has the opportunity to customize their portfolio through their participation. And I think that's quite empowering, right? Because you're not just putting money or rebalancing it into the entire portfolio, you're doing very targeted investments, or rather your fund manager is taking care of a much more sophisticated approach to investing. And again, here I think this is why you need both PMS and MF in your portfolio, because when you do your additional contributions, this is where the value addition comes from the PMS side, right? We are able to work more closely with an investor's money and do something that is contextually more relevant than what a mutual fund could particularly do. And again, this is why that pairing of both products can result in better outcomes for the investor, because on one hand, you might have something that's more tax efficient, you might have a wider array of asset classes that you can participate in. For example, you can't really take direct global exposure in a PMS, but you can do that in a mutual fund. And so I think the synergies are really good, and an investor needs to figure out what is the right mix or what is the right balance that would work for them in that context.
Right. I'm just going to quickly catch on to that one phrase that you said. You said pairing as a strategy. How do you think that will differ from one investor to another?
So pairing always has to be done in line with your risk profile as well as with the product mandate, right? So for example, if you have, let's take Solitaire, which is our flagship PMS FlexiCap product. Now, we don't buy any leveraged businesses in that product, right? It's also a pure equity product. So there is scope when an investor chooses to pair Solitaire with mutual funds. There is scope for us to give them a flavor of asset allocation through mutual funds. There is scope for us to participate in themes today like banking and financial services through the mutual fund route. There is an opportunity for an investor to have global exposure and own Solitaire. So these are all complementary ideas that are going together. You're not replicating your efforts anywhere, but maybe it won't make sense. So I think when you're able to do this pairing, it needs to be a little bit more strategic and it needs to be more personal. It cannot just be that, oh, like, let me do some SIPs in mutual funds, let me do a PMS somewhere, and then probably I got exposure to both mutual funds as well as PMS. No, it has to be more specific and it has to be designed. It cannot be arbitrary in nature.
Right. So she makes a very interesting point about how even pairing as a strategy is not a one-size-fits-all approach. It needs to be based on what kind of an investor you are, what risk appetite you have. So these are some things that you may want to consider before you think of investing in either of these products. I hope it has been an interesting conversation so far. Stay tuned for part 2 as we dive deeper into the most debated topic, PMS versus MF, as we speak of some more technicalities.